Hey everyone, hope you're having a fantastic day. Here with another episode of Planning with Advice by Mariano, and of course that is myself. I have my accomplice, So Chill the Gray, always wants to play, and there she goes, running with intensity. So as I entertain her, I will tell you guys all about an investment strategy called dollar cost averaging. And now that's just a fancy set of words to basically say, putting in money at different intervals of time, such as saving regularly with money coming off of your paycheck through your employer, or just setting up an automatic savings plan through your bank or your investment company. And it's a strategy that allows you to reduce risk of buying in certain investments that fluctuate in value, such as stocks, mutual funds, segregated funds, even currency. And I'll give you an example. Let's say you want to invest $1,200 or $12,000 or $120,000. Instead of doing that all at one time, such as the beginning of the year when you are topping up your RSP in January and February, or even your TFSA, and putting in that whole chunk of money in one time, you're basically buying shares all at one price. The risk of potentially buying them at a high is definitely there. Obviously, you can benefit the other way around, and if the market's not doing very well at that time, then that would work in your favor. However, it's very difficult to know when the markets aren't going to be doing well. Market timing is very difficult. Everybody always says, buy low, sell high. Of course, we want to do that, but it's not something that is very, very easy to do. And you never really know when the market's going to stop, going up or start to decline. The best investment specialists in the world are only speculating. They may use very big words and talk about things with a lot of certainty and then back it up with certain facts. Yeah, I'm not saying that they're not correct, but they are talking based on opinion. So the way that you can reduce the risk of buying in at a high is to dollar cost average. So basically take your 1,200, 12,000, 120,000 and split it up over the course of 12 months. You can invest that money monthly, bi-weekly, weekly. Even the more frequent, the better, because you're buying shares or currency at different prices every week. And basically the average of that, generally speaking, will be better than if you were to just buy in at one single time in the market. It's a safer approach. It's not an approach that is 100% guaranteed to yield a better result, but it is very, very difficult to make that comparison. And so I just want to let you guys in on a little example that I have for you. So I buy US currency quite often in order to fund my future vacations. And so basically I'll buy a little bit every week or every 2 weeks when I get paid, and build up a US currency fund where when I go on vacation, I'm ready to rock and roll. And that means, because I don't necessarily know always in advance when I'll be going on vacation and what the US dollar will be at, so I buy it at all different prices. And in theory, it averages out to have costed me less than if I decided to go on vacation in 6 months, and at that point in time, the US dollar is very high. So that's a little example for you. It can work for stocks, mutual funds, segregated funds, and there are other asset classes that fluctuate in value. I'm not going to get into that today. Just wanted to give you guys some examples. But basically, the theory behind it is that any asset class that fluctuates, you can reduce your risk by spreading out the amount of money you want to put into that asset class over a period of time. So I hope that helps. I want to let you guys know that I'm always open for topics. If you are thinking about something and you want to know more about it, I either can tell you myself. I have a team of experts, investment experts, insurance, mortgage experts that can help us to get the answers for you. So I'll let you guys go for now. I want you to have a fantastic weekend, and hopefully the Raptors win. Take care.